All right. Well, we should be live here shortly. I'm pulling up here. Yep, we're good. We're live. Um, and wanted to take a moment here and introduce my good friend Eric. Eric and I went to high school together, so it's been a bit. Now, Eric, I'd like for you to share a little bit about kind of your background, what you do. Sorry, as I get my computer focused here the right direction. Um, in your work with the bank. Tell us a little bit about kind of who you are. Tell us your background. How'd you get here?
Yeah, absolutely. Appreciate that, Matt. And first off, thanks so much for having me. I think I've let everybody know that this is a little bit different for me. Really appreciate the encouragement on me sticking my neck out and getting on some social media. So really appreciate you having me on this afternoon. Anybody that doesn't know me, my name is Eric Weichselbaumer. I'm from Arvada, Colorado, originally, and now I live up north actually in Matt's neck of the woods. Him and I are almost neighbors. I've been in banking for about 15 years. Started in a call center at a local bank, which is really where I learned all I know about banking. From there, decided that I wanted to maybe get into a little bit more of a management role. Managed a small team. And ended up actually managing a call center within that bank, which was a great experience. And then I decided that I wanted to get out and meet people face to face and have a little bit more hands-on experience with any clients or customers. So from there, I bounced around a little bit, but then I found Chase Bank. Everybody knows Chase Bank. Bled blue for a little bit and spent actually just under 8 years with Chase Bank at various locations and various positions. And then now I'm working in small community banks, and I've worked with our CFO, CEO for about the last 4.5 years now. And I'm currently with Bank Central. We've got offices in Colorado Springs, Denver, and Durango of all places. And we primarily focus on small business, commercial, rental properties. We do mortgage, we do traditional banking as well, but we typically lead in with kind of the premise that 100% of small business owners are consumers and not necessarily the other way around. And it's kind of a niche that we've carved out for ourselves.
Yeah, and as you've spent really 15 years in the banking industry, you clearly knew exactly what you wanted to do and how you wanted to do it at a much earlier age. I personally bounced around from a couple of different things, did spend many years in the motorcycle industry. I was selling toys before I got into real estate. And for background, right, if memory serves, you were a heck of a soccer player and a heck of a golfer.
Yeah, I'm neither now. I enjoy golfing. I play a lot of golf still. I actually live on a golf course, which has been great. And soccer, I'm still an avid soccer fan and love the sport. And soccer and golf are probably my main go-tos. I enjoy all sports, but I definitely was involved in both of those in high school and early adult life. And now golf seems to be the primary go-to for a little bit of stress relief, and you can also do a little bit of business on the golf course occasionally. So
that's what people keep telling me. I keep telling them they're not doing any business on the golf course; they're simply just having fun.
And you can combine both, right?
Yeah, it's possible. Now, as we jump into this, I know there are some specific things that you wanted to discuss and talk about, some things that you're passionate about. And one of them, kind of more of a niche for you, is the investment side of it within real estate, right? The rental market and investment opportunities. So let's dive a little bit deeper into that. What excites you about real estate investing and investments?
Yeah, so there's a lot of things that are exciting about investing in real estate. It's a great opportunity for a lot of different reasons. What we're finding right now is that you can still work a 9-to-5 job, and you can also have an alternative investment that could quite frankly become your primary source of income one day. That's one piece, and it's a great diversifier. I think a lot of folks right now are, although it's probably a bad time to say it, a lot of folks typically have their 9-to-5 job. They got a 401k, and that's it. And so there's affordable ways to get into owning your own investment real estate, piece of property. And we can talk a little bit about different markets here in a little bit. But it's a way to diversify your income. It's one of those where you can have your mortgage paid for by somebody else, and you can gain equity in your home, which is the amount that your house is worth related to your loan amount. And that's, as you pay your loan down, obviously you've got money available. And then also the appreciation factor, which Colorado's been a great example, and continue to be a great example for growing equity in properties in a relatively short amount of time compared to other places in the country. So what we're seeing is a lot of folks that are interested in it. And what I'd like to do is take a little bit of time to maybe explain the differences between a traditional mortgage product and some of the investor opportunities out there. Reason being is we get a lot of inquiries. People are ready to invest. They've got down payment, they've got good income, and they're expecting a typical mortgage process. And quite frankly, it's just a little bit different because there are normally there's a couple of differentiators when it comes to investment real estate, right? So if you go to a traditional mortgage banker and you say, hey, I want to buy an investment property, the interest rate could potentially be a little bit higher because it's not an owner-occupied property, meaning you don't own the property. There are some things that may be affected by the term of your loan. So, 30-year amortization, which is the amount of time that it takes you to pay your loan. Sometimes that's not available on an investment property, quite frankly, in my opinion, for maybe the right reasons on that front. And then you might expect to pay a fee of some sort when it comes to getting into an investment real estate over and above just doing a traditional mortgage where maybe you might be accustomed to not having a fee. And there's a couple of different reasons for that. Typically, there's really two different ways that you can go about getting into an investment property. And the probably most common method that people think is, I'm going to buy a property, I'm going to put it in my own name, and I'm going to go ahead and acquire that property and use my mortgage banker or whoever did my primary residence, which is all great. Honestly, that's a great way to go. But something to think about is, what's the liability on you and your personal assets if you have a property that somebody else is living in that could potentially catch the house on fire, could potentially have a dog bite a neighbor, slip on an icy driveway, fall on a crack. There's a number of different things that could potentially point right back to you and your personal assets. So typically what we advise here at Bank Central is to put that in the name of an LLC or a corporation. And really what that's doing is that's sheltering your liability. So if something were to happen, heaven forbid, basically what that looks like is they can go after assets in the LLC, but they can't go after any of your personal assets. And with that comes a little bit different type of a loan product. Again, kind of already touched on it a little bit. You typically could, see an origination fee on that loan. You could typically see a lower amortization schedule. Not always, but typically if you're investing, maybe you got a little bit of excess cash. We want to see that loan paid down a little bit quicker, and I think that's going to be pretty consistent across the board. So you might look at a 25-year or a 20-year amortization, again, which is the amount of time it takes to pay your loan. And then you also might see just a little bit higher interest rate. Now, interest rates are great right now. And it's interesting. I'm sure you see it too, Matt, where people are complaining about getting money at 4.5%. It's still cheap money, in my opinion. And there's
what was your first mortgage rate at, Eric?
My first mortgage, we bought our first house in 2009 of all times. So right after all kind of in the mess a little bit after. And our first mortgage rate was 6%, which according to our parents, is a heck of a deal. So obviously, interest rates are quite a bit lower now, but 4.5% on a commercial type loan to get you into a rental property that's going to cash flow is probably a pretty decent deal for you. So.
Yeah, absolutely. And I've been told that the historical average for mortgage rates is around 8%. My first one was a 6 as well. Was a great rate there at the time. Took advantage of refinancing. So today, when you can get owner-occupied rates under 4, you're doing phenomenal. Sometimes under 3 if you're looking at certain products. So you brought up something that I want to touch on just a little bit, which is putting the loan or the property in the name of an LLC or a corporation, and the lending product specifically with that, where sometimes a traditional lender, they're not going to be as comfortable with that property not being in there because of a thing called recourse. What can you share with me on that?
Yeah, so excellent question that I wasn't necessarily prepared to discuss, but I could certainly chat about that as far as recourse is concerned.
Yeah, hit the highlights, right? We could talk to an attorney on the specifics.
That's correct, absolutely. So Matt, what you're referring to recourse-wise is if I have a recourse loan, which is going to be a mortgage loan for anybody, you are personally held responsible for that loan. So if you default, you could potentially experience things like credit dings. The bank or your mortgage company could go after you personally. On the commercial side, which is where we do a lot of these investor property loans, there is a possibility of what we call non-recourse. So the loan is in the name of a business, and the liability is on the business and not necessarily the individual, which means that you would have what we call a non-recourse loan. So although you're signing the documents and executing the documents in the name of your company, if something happens, let's say like maybe COVID happens and your tenant leaves your property and you can't make your payment, there's no negative actions, credit reporting wise, or legalities that would go against you personally. Basically, that would just be the asset at that point that would be up for grabs, if you will, if anything negative were to happen. So great question. We do see that. Typically, that's at a little bit larger, what I'm going to refer to as an exposure limit. So larger dollar amounts. There's typically a threshold set by most institutions that are doing commercial lending that will allow you to go into that non-recourse arena, and that's going to fall again under a lot of the lending guidelines set forth by the financial institution. So great question, and yeah, we could talk for an eternity about that. But yeah, something really good to know, and that's another major difference between a traditional mortgage product and potentially a commercial product as well. Or if you're looking at investment properties, that's something really good to know. Great question to ask a lender or your favorite real estate agent.
Well, the takeaway from this is that not all lending institutions are the same. Not all lending products are the same. So, when I was in the motorcycle industry and I was helping people finance their Harley Davidson, well, it was a very straightforward deal. It was, here's the interest rate, here's the term, here's what the payment is. Mortgage lending, whether that's commercial, it's owner occupied, it's an investment property, they're so varied. There's so many different ways to do it that it's not just as simple as, well, here's the interest rate, the best rate, and that's what I should take because I'm been conditioned to. It really comes down to having a great conversation with your loan officer as to what's my goal? What do I want to accomplish? What do I want to do here? And what am I comfortable with?
Yeah.
So
yeah,
asking great questions and having great partners to go to is super critical. Where, again, if you didn't like the interest rate on the motorcycle purchase, well, that's fine. We could probably find a different interest rate and you could still purchase the same property, and that doesn't change anything.
Right. I've got a couple thoughts on that. That's a really good point. So first and foremost, you nailed it saying that, not all lenders are the same. And first and foremost, I would encourage anybody that's looking for, whether it be a motorcycle loan or a mortgage loan, or they're buying a multi-million-dollar business, make sure you're comfortable who you're working with. And if you don't quite know what to ask, reach out to folks that do. Real estate agents are great. They all know lenders, right? Lenders, I think lenders can provide some insight. And aside from the product and am I getting a good deal and do I like, how this is going to work? I think you gotta connect with that individual and like to work with them. I think that's important. If you're working with somebody because they're offering the best interest rate and your payment's going to be low, but they're not easy to work with, or it's just not meshing well because of personalities, which unfortunately can happen. I would say maybe do some research and make some phone calls. Again, reach out to a realtor, reach out to a financial professional. CPAs are also a really good resource for knowing folks that can assist, because I think that's the most important part of finding that. And then, again, having the guidance, from start to finish, especially if it's one of your first transactions. Again, I can remember the first time I bought a car with a loan, and that maybe felt like signing off on a mortgage at that time. And so make sure that you're comfortable. It's a big deal to most folks, and that's probably the best piece of advice that I can offer to anybody, when it comes to potentially entering into these transactions. So.
Yeah, good partners ultimately help the deal go smoother. It's going to help everything throughout the entire process. So having knowledgeable people that can get you connected to the right answers, and somebody that's not afraid to say, hey, I don't know the details on this, or I'd like to do more research on this, but let's go find out the actual answer, right? Because if I'm going to give you an answer, I want it to be the factual answer, not just well, hey, I think it maybe used to be kind of, I don't know, let's just try it and see what happens.
Absolutely.
We're talking about a large financial transaction that, can have a huge impact. So, as we talk about real estate investing, what are some things, right? If I'm brand new to real estate investing, have no idea what I want to do, what are some conversations or some questions that you would ask or want to know as the person that's my go-to source, right? I'm new to real estate investing, Eric. What do I need to know, right?
Yeah, great questions. And by the way, these can happen with a lender. These can also happen with real estate agents. There are a lot of great real estate agents. Quite frankly, there's some real estate agents that only focus on investor type situations. There's very talented real estate agents that do both. So have these conversations. And quite frankly, the couple of questions that I would ask right up front, maybe even before I saw a property, is what is it going to cost me? What am I going to sign up for, and how much is this going to cost me? And when I say what is this going to cost me, think of things like, what happens if I have to turn over my property to a new tenant? So you've got a tenant in your property and they leave. Can you just next day rent it to somebody else? Typically the answer is no. You might have to clean it. You might have to make some updates. You might have to repair wall. You might have to clean the carpets. There's a number of different things that could come up with that. So how much is that going to cost, typically to get a new tenant into your property? And then how much time does that take? If you're in a market that's maybe a little bit slower, there could be a time where maybe you go 2 or 3 months without having a tenant in your property. And unfortunately, us, the big bag bank, typically want our mortgage payment every month. So that's something to take into consideration as far as cost is concerned, what we call a vacancy. The other pieces are insurance. You want to make sure that you've got proper insurance, obviously, but that's a cost associated. That's another thing on a lot of the investor type loans, especially if it's a bank loan. We typically don't escrow for taxes and insurance. So that's something that you will pay on your own, as opposed to having it what we call escrowed into your mortgage, which means that the mortgage company is going to pay your taxes and insurance on a monthly basis. And they're basically putting that aside so that they can manage that for you. On these investor properties, that's something that you actually take care of yourself. So again, what is it going to cost me? Secondly is going to be, what is my return going to be? What does my return look like? And what is my cash flow? So if your mortgage payment on let's just throw a $200,000 property is $1,500 and you're renting it out for $2,500, simple math would tell you you're going to make $1,000 a month. But what a lot of first-time or inexperienced investors don't realize is the additional costs that come with it. So again, what is your insurance? What are your taxes? What happens if I have a vacancy? Do I have a reserve in case I need a new roof because there was hail damage? Obviously, we get a lot of hail in Colorado specifically. That's a very real thing to take into consideration. What happens if I need to evict somebody? There's a cost typically associated with that. So again, those are a lot of things that you might want to think about before entering into that. And again, I think a lender or a real estate agent would be able to help you answer a lot of those questions. And that, quite frankly, is before you even go shopping. After that, you're typically going to want to, there's a lot of different models out there. You can find them online. Again, you can get them from your favorite real estate agent or a lender. And this can all be modeled, right? So there's a way that you can actually put it on paper to kind of see what it is, and you can play with it. So if I have to, put $1,000 towards my deductible for a new roof, what does this do to my financial model to see what my total return is? A lot of folks are really focused on the cash flow piece. It is important, and I think it really depends on where you're investing. But if you're in a major metropolitan market or submarket like Denver, Arvada, Westminster, Highlands Ranch, Littleton, Colorado Springs, there's a significant cost to doing business in a lot of these markets. So something to think about there.
Yeah, and great questions as we look at the big picture, because it's not as much of well, here's what I charge for rent, here's what my mortgage is. I get to keep 100% of the difference, because if you've ventured into real estate investing, what you found is that there's other costs and things to factor in, right? One of the things that I did really phenomenal with my first investment property was it was a house I was living in. A term called house hacking, which I didn't know at the time. Thought I was a genius just pioneering this thing. It's been around for a long time. But bought my house under owner-occupied rates because all I heard at the time were interest rates were low. There's a lot of vacancies. So that must mean that the prices are good. So I'm not a very smart guy. I wasn't in the smart classes with you, Eric. I was in the, the back of the class.
I think we were both in the back of the class, on opposite ends of the classroom.
Maybe back of the smart class for you. I didn't qualify for that class, but it was an opportunity for me to look at, hey, somebody else is going to help pay my mortgage. I'm going to live here. I got to live somewhere. I could have roommates in a rental and pay a mortgage or pay somebody else's mortgage, or I can be the landlord and have them rent for me and live cheaper. So that was great. And I bought in 2008. Things were cheaper, right? And as things appreciated, decided I would get really smart. My next venture was into Detroit. And things are not awesome in Detroit. And in fact, I tell folks, look, if you're going to invest in Detroit, you better know what you're getting into, because it's going to be a very different animal. So I bought 2 properties for cash because they're cheap. And what I found is that even though there's no mortgage associated with it, that doesn't mean that I'm keeping 100% of the money that's coming in, because there, especially in cities like that, you have very high rate of tenants that don't pay. You have stuff that gets stolen on a regular basis. I had a furnace stolen out of a property when it was vacant, right? So being able to budget and set aside those. So as we talk about cap rates, for example, somebody explained cap rate to me, which was phenomenal, which is it's an assessment of risk. The lower the cap rate, the lower the risk, right? I'm just buying my income at that point. Detroit's got a very high cap rate, which means I should have a lot of cash. It's a lot of risk there in Detroit. So,
Absolutely.
as we look at, and I've got a property that's not on the market yet. It's coming up here later this summer. It's a duplex. And it's been owner occupied for the time that she's had it. So the tenant upstairs rents out from her. She's paying, the tenant's paying $1,600 a month. The lower unit is the one that she's living in, right? So as this gets sold, tell me about, for those that are interested in just venturing down that route, right? They like the idea of somebody else paying their mortgage and house hacking, yet they don't want to have roommates. Right? My wife would never let us go back to having a roommate. Again, and I like my space, so it'd be a very special circumstance for me. But if I were to buy into a duplex, what kind of lending programs, what do you have? What would you recommend as I'm looking into that?
So great question. So duplexes are great. You mentioned it, especially if you want to invest, but you also need a place to live, or you're tired of paying rent. I think most of us lenders and real estate agents are pretty high on the, why the heck are you renting and just giving your money to somebody else. Duplex is a great introduction for a couple different reasons into the investment world, in my opinion. I hope you'll agree. Maybe not. Let me know. But you live in one side or on the bottom floor or the top floor, and then you have a tenant in the other side. That's good for a couple of different reasons, I think. And then I can talk about loan options. But you get to see that individual, hopefully, through the regular course of a day, might be able to get to know them a little bit. And that could potentially play into your advantage as you grow that relationship and have that tenant, and they're paying some, if not all, of your mortgage on that front, which is really nice. So I think that's probably a really good way to go. As far as lending options, you also mentioned something that I think is very smart that you mentioned that you did with your first property. And that is you basically qualified under a primary residence because you didn't own any other real estate at that point in time. If you don't own any property, I think that is absolutely the way to go. And there are ways that we can help you with getting it into the name of an LLC after you qualify for that primary primary residence financing. Again, the benefit of that is that interest rates are typically the best when it's your residence or your property and it's your primary property. So I just wanted to mention that. I think that's smart. And if you have the opportunity, or if you're looking at potentially investing or doing, what did you call it? House jacking?
House hacking, yeah.
House hacking, sorry, not jacking. We're not jacking any house.
We're not stealing people's houses.
Yeah, exactly. Yep, we're not in that business. So, but if you want to do the house hacking thing, what a tremendous opportunity, getting 30-year fixed financing. Rates are obviously at all-time lows, as you indicated earlier. You could be below 4% potentially, and then have roommates or somebody else potentially paying your mortgage for you, which again can help you cash flow and build equity. So sorry, went off on a tangent there. So as far as lending programs on a duplex, typically what we'd probably end up doing, and most commercial bankers for an investor type opportunity would probably require somewhere between 25 and 30% down. So you might need a little bit more than a traditional mortgage. And then your interest rate would probably be somewhere between right now 4% and 5%. And there's a couple of different factors that go into that. And then this is probably one of the biggest differentiators. I mentioned that you would probably have a 25-year amortization, again, which is the time frame that you can be allowed that it takes to pay down your loan. We set a term within that amortization. So typically what we do is maybe a 5-year or a 10-year term. And basically what that is that's the time that the bank's committed to lending money to you. So if we set a 5-year term, we are going to do the loan for you for 5 years. You'll still have that 25-year amortization, but at the end of 5 years, we need to renegotiate the terms of the loan. And typically the reason that happens is a lot of the commercial loans are typically the bank's own money that they're lending you. It's not government money, which is pretty consistent with, if you're doing a primary residence or a traditional mortgage type of a transaction. So there's significant risk to the bank with interest rates. So typically the bank likes to renegotiate that to make sure that that they're not losing money, and that is us big banks being greedy. But that's pretty typical of something to find on the commercial realm when you're talking investment properties. So if somebody starts talking about a 525 or a 1025, that's what they're referring to is the term and then the amortization schedule for those types of loans. So I'm trying to think of anything else. I think those are kind of the main points if you're looking at getting into an investment property. Sometimes we have investors, if we go to a 25 or a 20-year amortization, and they say, well, this doesn't work for my financial model. And sometimes they use that as a form of bargaining, which is great. We want to get you, the customer, or our customers, the best deal possible. But a question that I always ask back is, if your financial model is this tight because we're taking 5 years off, or because we're doing a 25-year versus a 30-year, are you in the right investment? I think is the question that I ask, and I think it's a valid one. And sometimes that helps to maybe guide folks without telling them, maybe you shouldn't be into this, or you should absolutely be doing this. There's a number of different factors that go into that, but definitely a question to think about if you're venturing into maybe owning some of your own investment real estate someday. If it's that tight, or if you don't necessarily have, if you have $5,000 and you want to go buy a $200,000 property, maybe weigh your options and really sit back and talk to a professional or a resource about what it'll cost you. So hopefully that helped answer some of your questions there.
Yeah, without a doubt. And I love the fact that you said that if the numbers are that tight, maybe it's not a good investment. And the numbers in real estate investing should not be emotional. It should 100% be numbers driven. So for those folks that are watching this, if you want my spreadsheet on buy and hold properties or fix and flip properties, let me know. I'm happy to send that to you. So you let the numbers tell you exactly what to do. So the numbers are going to say this property works or this property does not work. And the tighter those numbers become, the more stringent you need to be on what it is that you're buying. Because real estate for flips, for example, on a flip, right? There's always something else that comes up. There's always more money that it costs. It always takes a little bit longer than you think it's going to be. And in the 1 out of 100 where it doesn't, great, you made a little bit more profit, but you got to budget for those. So if the number's that tight, maybe it's something you need to walk away from and continue to find a better investment. So, real estate, you want to make your money going into it on the front end of it. You want to know it's a great deal. I think where a lot of folks got into trouble in real estate investing through the 90s and early 2000s is they were banking on appreciation. Now, appreciation is the gravy. It's the cream on top. It is the extra that you get. We've had great appreciation in Denver Metro over the last, 8 years or so, 9 years. So, and yet if we are banking on the appreciation and anything changes, one thing changes, COVID happens, and people are all of a sudden not making their payments, that's going to have a big impact, right? So run the numbers, make sure that they work. And I'm passionate about making sure that the numbers work, because if they don't, now you have a big liability potentially. And with real estate, as long as you can afford to keep it, you should never lose. Right?
Yeah, absolutely. It's a great investment. A lot of people are doing it. A lot of people have become, pretty financially independent because of it. It's fun to be on both ends. I'm sure for you as well, Matt, just seeing what people are doing, and everybody's got just a little bit different strategy. And I think that's what makes it so beautiful, because there's so many different ways to make it work. Again, I can't emphasize enough, make sure you're asking the right questions, especially if you're a first-time investor. And real estate agents, CPAs, lenders can all be great resources. I wanted to mention, though, that there's also some companies out there that can, quite frankly, walk you through soup to nuts, not only preparing budgets, the financial models. They can help you with the property management side. We haven't even talked about that, probably a conversation for another day, but you can hire somebody to manage your property so you don't have to do anything with it. And that, if there's a leak in the sink at midnight on Christmas Eve, you don't have to deal with it. You let your property manager deal with it. So, there's a lot of companies out there that'll walk you through the financial models, what it's going to take. They typically have lender resources. They can, walk you through all the steps so that you can get comfortable, and then, potentially do it on your own, because there's certainly a cost savings associated with doing that. But know that those resources are available. Again, can't emphasize enough. Reach out to your real estate agent, reach out to your lender, reach out to a CPA. Most of us have those resources available if you're interested in getting going.
Yeah. So, as we wrap up this conversation, anything else around your experience in banking, your company specifically, that folks might want to ask more questions on, or look deeper into, what would be kind of the parting words that you'd want to leave them with?
Yeah, absolutely. So just a couple of thoughts. And again, Matt, thanks so much for having me. It's been fun. Hopefully we can do this again in the future. I think we uncovered a couple of topics we could talk about potentially in the future. There's a lot happening out there right now. And we've been through a lot, all of us. COVID is what it is. I know that Matt and his wife, Brenna, always mention this, and I just wanted to echo it. If anybody out there is struggling or needs any help, I would be more than happy to be available as a resource. I know Matt would be more than happy to be available as a resource. Send us a message, send us a text. We can keep it anonymous, and we can certainly do anything in our power to help you through whatever you're going through, because there's a lot of different scenarios out there, and I say that pretty sincerely. So know that. And then, the only other thing I wanted to mention, and this isn't necessarily investment real estate, but on the business side, there's been a lot of government sponsored programs, most recently through the CARES Act. If you own a small business and you're struggling, please reach out to your lender. I'm happy to be available as a resource, whether you're a bank client or not. There's a lot of different programs out there available that have some pretty sweet perks. 6 free months of payments, free money. Those are all kind of trigger words right now. But if you're a small business owner and you need some help, or if you know a small business owner that's struggling, reach out to Matt, reach out to myself. Him and I communicate pretty regularly, and we're more than happy to help any way we can with any of those potential situations out there, because we know that there's a lot going on. So other than that, that's about all I got.
Well, yeah, and I appreciate you sharing that. And it's there's a lot of programs out there for folks that just need a little bit of assistance to float through the time until things are open back up a little bit more regularly for them. So, again, for those that know anybody in that situation, or they are in that situation, let us know, right? I'm passionate about making connections and helping to connect those dots for folks. So let me know what dot you need, and I'm happy to cover that gap and make that introduction, right? So, and Eric, thank you so much for being part of this. I really appreciate it. I got a lot of value out of it. I hope the folks watching got a lot of value. And if you need to connect with Eric, let me know, and I'll get you Eric's contact information, with his bank and the things that they're doing. So. Awesome.
Perfect. Thanks so much, Matt. Have a great afternoon, everybody.
You too. Appreciate it, Eric.
Thanks.